The gold plunge nobody saw coming, how central bank digital currencies just rewrote the old approach just got more expensive. The practical edge now comes from changing process, timing, and tooling together. We will map trigger, incentive shift, and downstream impact before the close. On the surface, it looks like a typical overbought reversal RSI below 30, resistance failure, profit taking after a bull run. But here's what institutional desks saw that retail traders missed. For the first time in 23 years, gold's correlation with real yields inverted during a dollar strength event. That shouldn't happen. When the dollar rises and real yields compress, gold historically moves sideways or up slightly. Instead, it cratered. The last time this happened was September 2001, when the entire safe haven framework reset overnight. Something structural just broke. On June 18, the European Central Bank published technical specifications for digital euro settlement infrastructure, specifically, wholesale CBDC custody protocols that allow institutional investors to hold digital euros with the same legal treatment as physical gold reserves. This 247-page document buried in an ECB working paper went almost unnoticed by financial media. But it didn't go unnoticed by sovereign wealth funds. Within 36 hours, three things happened simultaneously. Norway's government pension fund Global, the world's largest sovereign wealth fund managing $1.6 trillion, disclosed it had established digital currency reserve infrastructure capacity. No amount specified, but the disclosure signals allocation intent. The Bank for International Settlements released data showing wholesale CBDC transaction volumes jumped 340% month-over-month in May, hitting $89 billion. 90% of that was institutional safe haven positioning, not payment flows. And Goldman Sachs commodity desk quietly downgraded gold from overweight to neutral, citing structural safe haven diversification. Connect those three dots and here's what's actually happening. Institutional money is treating programmable, yield-bearing digital fiat currencies as a complement or alternative to gold in safe haven portfolios. The market just priced in the first wave of that reallocation. Now here's why the next 8 weeks matter more than the next 8 months. In August, the IMF publishes quarterly reserve composition data. If even 2 to 3 emerging market central banks show inaugural CBDC reserve holdings, even token amounts, it validates the asset class for reserve managers globally. Whisper Networks suggest the Philippines, UAE, and Singapore are candidates. A positive August disclosure could trigger $40 to $60 billion in institutional flows out of gold into digital reserve assets by year-end. September 15, the Basel Committee releases final guidance on CBDC risk weighting for bank capital requirements. If wholesale CBDCs get the same 0% risk weight as sovereign bonds versus gold's current 50% risk weight, bank treasury desks face massive capital efficiency incentives to rotate. Every $1 billion rotated from gold to CBDCs frees up $500 million in regulatory capital. That can be deployed into higher return assets. October brings the first digital euro ETF applications to the SEC. Unlike gold ETFs holding physical metal or futures, CBDC ETFs offer programmable features, automated rebalancing, yield generation through central bank deposit facilities, real-time settlement. For the $200 billion physical gold ETF market, that's an existential threat. Franklin Templeton's June 18 trademark filing for Digital Reserve Fund wasn't coincidence. But here's the counterargument that's genuinely substantive: CBDCs carry sovereign counterparty risk that gold doesn't. A digital euro is ultimately an ECB liability. Physical gold is no one's liability. In a true systemic crisis, war, cyber collapse, institutional failure, gold's zero counterparty risk property becomes invaluable. The $13 trillion question: do institutional allocators believe the probability of such crises justifies gold's 0% yield versus CBDC's potential 1 to 2% deposit rates? China complicates this entirely. The People's Bank of China added 225 tons of gold in Q1 2026 alone, its fastest pace since 2015. While Western institutions rotate out, Beijing is buying aggressively. By 2028, China could control 25 to 30% of global official gold reserves, giving unprecedented pricing power and geopolitical leverage. We're potentially watching the greatest safe haven wealth transfer from west to east in modern history. Technology risk is also unproven at scale. No CBDC system has been stress tested through genuine financial crisis. A single smart contract exploit, settlement failure, or cyber incident collapses confidence overnight and sends trillions flooding back into physical gold. The June 2026 DeFi bridge exploits, $4.2 billion stolen across 3 protocols, remind us that code-based assets carry tail risks that 5,000-year-old gold doesn't. The reallocation thesis doesn't require CBDCs to replace gold, just to siphon 5 to 10% of safe haven flows. That's enough to structurally change gold's price trajectory. Sophisticated allocators are positioning for 3 scenarios. Scenario A, gradual rotation where gold drifts to $3,800 to $4,000 over 18 months as 5 to 7% of institutional safe haven assets migrate to CBDCs. Scenario B, bifurcated market where Western institutions rotate towards CBDCs while Eastern central banks and retail investors in India and China continue accumulating physical gold. Scenario C, CBDC failure event where a major technical or political failure discredits the category and triggers a violent gold rally to $5,200 plus. The smartest desks aren't making binary bets, they're buying volatility. Gold options implied volatility is pricing 18% annualized while realized volatility over the past 90 days has been 24%. That mispricing won't last once more participants recognize we're in a safe haven regime shift, not a technical correction. So what does this actually mean? Gold's June 20th plunge isn't a typical overbought reversal, it's the market's first real-time pricing of a new asset class challenging gold's 5,000-year monopoly on counterparty-free safe haven demand. The ECB's wholesale CBDC infrastructure, sovereign wealth fund positioning, and upcoming regulatory clarity create a 60 to 90-day window where institutional flows could decisively reshape $13 trillion in global safe haven allocations. The trade isn't long gold or short gold, it's understanding that safe haven diversification is happening faster than consensus models assume. The next 8 weeks of central bank disclosures will determine whether this is a 5% rotation or a 20% structural shift. This is worth paying attention to. 3 days ago gold dropped 1.7% and everyone called it a technical reversal. But watch this, for the first time in 23 years, gold's correlation with real yields just inverted during a dollar strength event. That shouldn't happen. On June 18, the ECB announced wholesale CBDC custody protocols, meaning institutional investors can now hold digital euros with the same legal treatment as physical gold reserves.